Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to our deep dive, into private equity.
Oh.
Specifically, what experts are predicting for 2025.
Okay.
We're going to unpack a detailed report by Dechert. They're a global law firm.
Right.
And they surveyed over 100 PE firms all over the planet.
Wow.
So get ready for some fascinating insights, minus the usual jargon, of course.
You're absolutely right. This deep dive is all about those key takeaways. The Dechert report really gets into the nitty-gritty of what's driving PE firms' decisions.
Okay, let's jump right in. The report describes 2024 as a roller coaster year for PE, starting slow but finishing with a bang.
Yeah.
Easing interest rates probably had a lot to do with that, wouldn't you say?
It was definitely a major factor. Lower interest rates mean it's cheaper to borrow money, making those big deals more appealing. Plus, we saw a resurgence of mega deals, those billion-dollar acquisitions that grab headlines. And get this, there's a record $2.62 trillion of dry powder sitting out there.
Wow.
That's uninvested capital, just waiting for the right opportunity.
That's a lot of firepower ready to be deployed. It suggests that PE firms are feeling pretty confident about the future, despite all the uncertainty we saw in 2024.
Confidence is a good word for it, but there's also a healthy dose of caution, especially when you consider the outcome of the U.S. presidential election. The report dives into how PE firms, particularly those in North America, reacted to Donald Trump's victory.
It was a pretty polarizing election, so I imagine there were some mixed feelings in the PE world.
You're spot on. Some firms were quite optimistic, especially in North America, hoping for tax cuts and a less regulated environment. But others expressed concern about potential protectionist policies and the overall uncertainty that comes with a change in leadership.
Speaking of uncertainty, the report also dives into the challenges PE firms are facing in raising capital. It doesn't sound like it's been a walk in the park.
Not at all. Global instability tops the list of concerns, understandably, given the geopolitical events of 2024. But there are also sector-specific issues at play. Competition for investor dollars is fierce. There's pressure to reduce fees, and we're seeing the rise of democratization. More individual investors trying to get a piece of the PE pie.
That sounds like a tough balancing act for PE firms. They need to cater to different types of investors while navigating a complex global landscape.
Exactly. They're having to adapt and innovate to stay ahead of the curve. Now let's talk about the deals themselves. What's trending in 2025? Well, club deals where multiple PE firms team up to share risk and expertise are very much in vogue.
Interesting.
Take private deals, on the other hand, are cooling down a bit as public companies regain some of their luster. But here's what really jumped out at me. Every single PE firm surveyed is actively pursuing sustainability and ESG-related investments.
It's remarkable that sustainability has become such a universal focus in the PE world.
Yeah.
It's clearly not just a passing fad.
It's a fundamental shift in how PE firms approach their investments. And it's not just about being good. They're seeing real opportunities for financial returns in areas like clean energy and resource management.
So they're realizing that doing good can also be good for business.
Precisely. Now, before we dive deeper into sustainability, let's talk about another major force shaping the PE landscape, private credit. This market has exploded in the last decade, growing fourfold.
Wow.
It's both a competitor and a collaborator for traditional PE firms.
The report mentions some major players like Blackstone and KKR leveraging private credit in creative ways.
Right.
It's almost like a new playing field has emerged.
It's a dynamic and evolving space for sure. Private credit provides an alternative source of financing for PE firms and their portfolio companies, but it also competes for the same pool of investor capital.
So PE firms are finding themselves in a sort of dance with private credit, sometimes as partners, sometimes as rivals.
Exactly. It's a complex relationship that's reshaping the way PE deals get done. Now let's take a quick world tour and explore what the report reveals about regional dynamics.
Sounds good. Let's start with North America. They seem to be bouncing back nicely from the uncertainties of 2024.
They are indeed. The report highlights strong activity in sectors like technology business services and even the leisure industry, with some notable deals involving the UFC and WWE.
It seems like North America is leading the charge when it comes to PE investment. What of the EMEA region?
Yeah.
Europe, the Middle East, and Africa.
EMEA is being a bit more cautious. The geopolitical risks, particularly the events in Ukraine and Israel, are weighing heavily on investor sentiment.
Yeah.
Plus, the economic slowdown in many European countries adds another layer of complexity.
So a more subdued outlook for EMEA compared to the bullish sentiment in North America.
Yes, but there are some positive signs. Exit activity in EMEA has started to pick up after a slow start to the year, and as interest rates continue to fall, we might see a more robust recovery in the region. Now let's shift our focus to the Asia-Pacific region. It's always a dynamic and somewhat unpredictable market.
The report mentioned that China's economic slowdown is having an impact, but other areas like Southeast Asia and India are showing strong potential.
You've got it. While China faces some headwinds, other parts of the Asia-Pacific region are attracting significant PE investments. They offer growth opportunities that are hard to ignore.
It seems like PE firms are adept at adapting to the ever-changing global landscape, seeking out opportunities wherever they may arise. Now, before we move on to part 2 of our deep dive, let's circle back to a couple of key themes. The buy and build strategy and the evolving role of sustainability. The report emphasized that buy and build is still a core strategy for PE firms, but with a notable shift in approach.
Absolutely. It's not just about acquiring companies in the same sector anymore. PE firms are taking a more strategic approach, seeking out synergistic businesses that complement each other. They're looking to create value by combining different pieces to build something bigger and better.
It's almost like assembling a complex puzzle, but instead of just fitting pieces together, they're creating something entirely new and innovative.
That's a great analogy. Now let's talk about sustainability. It's not just a separate investment theme anymore. It's becoming integrated into core PE strategies like buy and build. PE firms are realizing that sustainability isn't just about being good, it's also about creating long-term value. They're factoring in environmental, social, and governance factors when making acquisition decisions.
So they might favor a company with a strong sustainability track record over a more profitable company with questionable environmental practices.
Precisely. They're taking a more holistic view, recognizing that sustainability is essential for a long-term success. And as we've seen, investors are demanding it, regulations are pushing it, and there's a growing recognition that it can enhance financial returns.
Well, it seems like the PE world is undergoing a period of significant transformation driven by a convergence of factors.
Yeah.
Geopolitical shifts, economic volatility, regulatory pressures, and the rise of new investment trends like sustainability and private credit.
It's a dynamic and challenging landscape, but also one full of opportunities for those who can adapt and innovate. And that's exactly what PE firms are doing, evolving their strategies, embracing new technologies, and seeking out creative solutions to navigate this complex terrain.
That's a perfect segue to part 2 of our deep dive, where we'll delve into how PE firms are evolving their management structures and fundraising strategies to adapt to these challenges and opportunities. Join us soon for the next installment as our deep dive.
Welcome back to our deep dive into the world of private equity in 2025. We've covered a lot of ground already, from the impact of political and economic events to the rise of sustainability and private credit.
We've definitely painted a vivid picture of the challenges and opportunities facing PE firms.
Right.
But now I'm curious, how are they adapting internally? The report had some interesting insights into how they're structuring their management companies to navigate this new landscape.
Yeah, one trend that caught my eye is the growing interest in taking PE firms public. Listing their management companies on the stock market. It's still relatively rare, but the report cites CVC Capital Partners' recent IPO in Amsterdam as a potential game changer.
It's a bold move.
Yeah.
What's the motivation behind going public? Is it all about raising capital, or are there other strategic advantages?
Well, it's definitely about accessing more capital.
Okay.
But it's also about boosting a firm's profile, attracting new investors, and potentially even tapping into cheaper sources of funding.
Okay.
Think of it as a way to level the playing field with those mega funds that are already public.
Well, wouldn't that create a conflict of interest? Publicly traded PE firms would be beholden to their shareholders, who might prioritize short-term profits over the long-term interests of the PE firm's clients,
Right.
limited partners.
That's a valid concern, and it's one that PE firms are grappling with.
Yeah.
The traditional partnership model prioritizes the fiduciary duty to the LPs, but going public introduces a new set of stakeholders
Right.
with potentially different objectives.
It's a delicate balancing act, to say the least. Now let's shift gears and talk about fundraising. We know it's been a tough environment for PE firms. So what are they doing to overcome these hurdles? The report mentions some creative strategies they're employing.
They're definitely thinking outside the box. One approach is to diversify their investment offerings, moving beyond the traditional one-size-fits-all fund to offer more specialized funds
Okay.
that cater to specific investor appetites.
It makes sense. Investors are becoming more sophisticated and discerning, looking for targeted exposure to certain geographies, sectors, or investment themes.
Exactly. For instance, we're seeing a surge in funds dedicated to Southeast Asia or renewable energy,
Check.
attracting investors seeking those specific opportunities. Another interesting trend is the rise of GP-led secondaries, or continuation funds.
Now, I remember that term popping up in the report, but I need a little refresher. Can you break it down for us?
Sure, imagine a PE firm has a fund that's nearing the end of its life, but they still hold some promising companies that they believe have even more growth potential. Instead of being forced to sell those assets prematurely, they create a new fund, a continuation fund, and transfer those assets into it.
So it's like giving those companies extra time on the runway to reach their full potential.
Exactly.
And I imagine this benefits both the PE firm and the investors in the original fund.
You got it. The PE firm gets to hold on to those promising companies, and the original investors have the option to cash out or roll over their investments into the new fund. It's a win-win situation, especially in a challenging exit environment.
It sounds like a clever way to adapt to the market dynamics we discussed earlier.
Yeah.
Now let's turn our attention to another critical aspect of the PE landscape: regulatory scrutiny. The report indicated that PE firms are facing increased pressure from regulators globally.
Absolutely, and it's a trend that's likely to intensify in 2025. One area of particular concern is antitrust regulation.
Okay.
Regulators are becoming more vigilant in scrutinizing deals, especially those that could stifle competition or create monopolies.
So PE firms need to be extra cautious with their buy and build strategies,
Yeah.
making sure they're not running afoul of antitrust laws.
Right.
The penalties can be quite severe, can't they?
They can indeed. Hefty fines, forced divestitures, and reputational damage are all potential consequences of non-compliance.
Yeah.
And it's not just antitrust regulations they need to worry about. National security reviews are also becoming more common,
Right.
especially for cross-border deals.
Governments are understandably concerned about foreign investments in sensitive sectors like technology and infrastructure. They want to protect their national interests and ensure that these investments don't pose any security risks.
You're absolutely right. It adds another layer of complexity for PE firms, requiring them to navigate a more intricate web of regulations and geopolitical considerations.
It sounds like PE firms need to have a sophisticated understanding of the regulatory landscape in each region they operate in. Now let's lighten things up a bit and talk about a more collaborative trend: co-investments. The report highlighted how these arrangements are gaining traction, especially in North America.
Co-investments are an interesting development in the PE world.
Yeah.
They allow PE firms to partner with their investors, the limited partners or LPs,
Okay.
on specific deals, sharing both the risks and the potential rewards.
It's like a joint venture where both sides have skin in the game.
Yeah.
What's driving this trend toward co-investments?
There are several factors at play. For PE firms, it provides greater certainty of funding and helps them manage their overall risk exposure.
Okay.
For LPs, it offers more control over their investments and the potential for higher returns than traditional fund structures.
So it's a win-win situation. The report indicated that co-investment programs are becoming increasingly common, especially in North America.
Right.
But what about fees? Are LPs getting a free ride on these co-investments?
Not quite. While the fees are often lower than for traditional PE funds, most firms still charge some sort of management fee and/or carried interest on co-investment vehicles.
Carried interest being the PD firm's share of the profits, right?
Yeah,
So even though LPs are co-investing, they're still giving up a slice of the pie.
that's right. But in return, they're getting more transparency, control, and potentially higher returns. It's all about finding the right balance and aligning incentives.
Now let's return to the buy and build strategy, a classic approach in the PE playbook. The report suggested that while it's still a core strategy, it's evolving in some interesting ways. What's changing in the world of buy and build?
Well, in the past, the focus was often on identifying a promising sector and then building a dominant player within that industry.
Right.
But now PE firms are taking a more nuanced approach, seeking out companies that are not just in the same sector, but also offer synergistic benefits.
So they're not just looking to build a bigger company.
Right.
They're looking to build a smarter company.
Precisely. It's about creating value through strategic combinations, leveraging the strengths of each acquired company to create something greater than the sum of its parts.
That's a great way to put it. It's like combining different ingredients to create a truly unique and delicious dish. Now, before we move on to the final part of our deep dive, where we'll explore regional dynamics in more detail, let's touch on one final element: the integration of sustainability into the buy and build strategy.
It's a crucial aspect of the evolving buy and build playbook. PE firms are recognizing that sustainability isn't just a separate investment theme.
Right.
It's an integral part of creating long-term value. When evaluating potential acquisitions, they're factoring in environmental, social, and governance (ESG) factors, favoring companies with strong sustainability track records.
It's fascinating how sustainability has permeated the PE landscape, from influencing investment decisions to shaping core strategies like buy and build. It's clear that PE firms are adapting to the demands of a changing world, recognizing that sustainability is not just about doing good,
Right?
but also about doing well.
That's a great observation. And as we'll see in the final part of our deep dive, this awareness of the importance of sustainability varies across regions, shaping the investment landscape in unique and intriguing ways. So stay tuned as we explore how different regions are navigating the complexities and opportunities of the PE world in 2025.
Welcome back to the deep dive. We've covered a lot of ground on our exploration of private equity in 2025, from global trends to evolving strategies.
And in this final part, we'll shift our focus to the regional dynamics shaping the PE landscape. As you might imagine, different regions present unique opportunities and challenges for PE firms.
Absolutely. We've touched on some regional variations, but the Dechert report provides a much deeper dive into these nuances. Let's start with North America. The report paints a fairly optimistic picture for the region, wouldn't you say?
Yes, North America seems to be rebounding well from the uncertainties of 2024. Easing interest rates, a resurgence of mega deals, and that massive pool of dry powder all point towards a robust PE market.
And it's not just a general upswing. The report highlights specific sectors where PE activity is particularly strong.
Exactly. Technology and business services continue to attract significant investment. But what's interesting is the growing interest in the leisure sector. We've seen some eye-catching deals involving companies like the UFC and WWE, indicating that PE firms are seeing potential even in less traditional areas.
So it seems like North American PE firms are adept at navigating choppy waters, finding opportunities even amidst political and economic volatility.
Resilience is definitely a key takeaway for North America. Now let's cross the Atlantic and see what's happening in the EMEA region, Europe, the Middle East, and Africa. The picture there is a bit more subdued, wouldn't you say?
The report certainly suggests a more cautious outlook for EMEA compared to the bullish sentiment in North America. It seems like the geopolitical risks, particularly the ongoing conflict in Ukraine and the recent events in Israel, are weighing heavily on investor confidence.
Those events have undoubtedly had a ripple effect across the global economy, and the EMEA region is particularly sensitive to these geopolitical tremors. The report also cites the economic slowdown in many European countries as a factor dampening PE activity.
So it's a more challenging environment for PE firms operating in EMEA, but the report did mention one positive sign.
Yes, despite a sluggish start to the year, exit activity in EMEA has actually started to pick up. As interest rates continue to decline, we might see a more pronounced recovery in the region.
Let's hope that momentum continues. Now let's shift our focus to the Asia-Pacific region, a market known for its dynamism and unpredictability. What insights did the report offer on this part of the world?
The Asia-Pacific region is a fascinating mix of challenges and opportunities. China's economic slowdown is undoubtedly a factor, casting a shadow over the region as a whole. But even with China facing headwinds, there are bright spots emerging elsewhere.
The report specifically mentions Southeast Asia and India as areas attracting significant PE interest. What's driving this trend?
Southeast Asia and India offer tremendous growth potential. These markets are characterized by expanding middle classes, rapid urbanization, and a burgeoning tech scene, all factors that are highly attractive to PE investors.
So while some investors may be pulling back from China, they're finding new opportunities in these other dynamic markets. It's a reminder that the PE landscape is constantly evolving, with capital flowing to wherever the most promising prospects lie.
It's a testament to the adaptability of PE firms, their ability to identify and capitalize on emerging trends and shifting market dynamics. Now, before we wrap up our deep dive, let's revisit two key themes that have woven their way throughout our discussion: sustainability and the growing role of private credit.
These are two forces shaping the future of private equity, and their impact varies across regions. Starting with sustainability, it was striking that every single PE firm surveyed is actively incorporating ESG considerations into their investment strategies. It's clearly more than just a trend. It's a fundamental shift in how PE firms approach value creation.
You're absolutely right. Sustainability has become a mainstream concern for investors, and PE firms are responding to that demand. They're realizing that integrating ESG factors isn't just about doing good, it's also about mitigating risks and enhancing long-term returns.
And the report highlighted how this focus on sustainability is influencing everything from investment selection to portfolio management, with PE firms actively seeking out companies with strong ESG credentials.
It's a positive development demonstrating that PE firms are recognizing the importance of aligning their investments with broader societal goals. Now let's talk about private credit. This market has experienced explosive growth in recent years, and its influence on the PE landscape is undeniable.
The report painted a picture of private credit as both a competitor and a collaborator to traditional PE firms. How is this dynamic playing out?
Private credit is competing with traditional PE funds for investor capital, offering alternative investment opportunities that appeal to those seeking higher yields and less volatility. But at the same time, private credit is also providing PE firms with new and flexible sources of financing, allowing them to structure deals in more creative and efficient ways.
So it's a complex and evolving relationship with private credit, playing a multifaceted role in the PE ecosystem.
Exactly. It's a testament to the dynamic nature of the PE industry, its ability to adapt and innovate in response to new challenges and opportunities.
Well, I think we've covered a tremendous amount of ground in our deep dive into the world of private equity in 2025. We've explored the global trends, the evolving strategies, and the regional nuances that are shaping this dynamic industry.
We've seen how PE firms are adapting to a world in constant flux, navigating political and economic uncertainties, embracing new technologies, and incorporating sustainability into their core operations.
It's clear that private equity is not just about finance, it's about shaping the future. The decisions these firms make have ripple effects across industries and economies, impacting innovation, job creation, and the way we live and work.
So as we conclude our deep dive, we encourage you to keep an eye on this evolving landscape. The world of private equity is full of complexities, but also brimming with possibilities.
Thank you for joining us on this journey of discovery. We hope you've gained valuable insights into the world of private equity and the forces shaping its future. As always, we welcome your thoughts and any follow-up questions you may have. Until next time, happy investing.